right, everyone, welcome back to the Wilson Weekly with Dr. Andrew Wilson and obviously me. Good morning, Doc. How are you this week?
Yeah, good day, me. And how are you, Graeme? By the way, Happy New Year. You know, it is the new year.
Happy Independence Day the other day, and Happy New Year.
Yeah.
Actually, Doc, Happy New Year and happy no interest rate rise?
Wow, unbelievable. Well, not unbelievable. We've discussed this for the last few weeks, Graeme. We delved into the minutes from the previous meeting from the Reserve Bank, and they were clearly sitting on the fence over June. They mentioned in their meetings that it was a close decision, that there were strong arguments for a pause and there were strong arguments for an increase. Now, the increase won over June, and guess what? Pause has won over July. But we need to talk about this, Graeme. It's a very interesting decision. Great news. Let's not quibble, Graeme. This is fantastic news if you've got a mortgage, and it's great news for the housing market that's already had.
Well, go back a step, Doc. When you bring human psychology into it, is it great news if we're just kicking the can down the street and they come back in a month or two with 0.5%?
Well, I would have thought it's important to, bring the populace with you if you're an economic policy maker, and they're our economic policy makers at the highest level, the Reserve Bank. They have a plan, they have a methodology, they have textbooks, they have research, all those sort of things, and they reveal this is the plan. This is what we're going to do. And this is what we're looking at in terms of, how we're going to activate our plan and what are going to be the factors that activate our decisions. So
I'm going to get you at a stand-up comedy club, Doc. I've got some of those textbooks with dust from school on them still, but I don't think those economic policies apply anymore.
Well, I think you're right. But at the end of the day, they've got to follow something. I mean, this isn't about getting the dartboard out, mate, and having a bit of a throw, and have every second square, or every third square up, down, steady, and just turn your back, put a blindfold on, throw a dart at the board, and that's what it comes up with, and that's the decision for the month. This isn't how we operate. We have to operate on some sense of logic and research and current data. And the Reserve Bank's been telling us that, from day one, when they started to increase rates, that their decisions will be determined by the data as it comes through, which they will be watching closely. So we need to look at, and as I said, firstly, I'm not quibbling about an interest rate pause. You're a mortgage holder in an environment of rising prices, highest, inflation we've had since the early 70s. And of course, the mortgage increases, the rate increases we've had, 12 since May last year. This is relief. This is good news, in terms of your bottom line, in terms of your household budget. So I'm not quibbling about that. But at the end of the day, the Reserve Bank's job is to control inflation and also to have high, full employment. But the main task now, because we've got basically full employment now, is to control the highest inflation since the 1970s. So, the plan is we have to stop people spending. How do we do that? What is our toolkit? Well, our toolkit is interest rates, our interest rates. And we're going to raise interest rates until people stop spending, until we see that inflation rate fall. Well, what's happened to that? What happened to the plan, man? We've seen 2 pauses in the last 4 months now, and yet the data is unequivocally strong, continues to be strong. We had some ups and downs in terms of the data over the past 3 or 4 months. But, Graeme, I've got a little bit of an inkling that some of those volatile data sets that we're getting out of the ABS reflect not so much what's actually happening, but some issues with the seasonal adjustment models that the ABS uses for their data, which we know has been turned upside down through COVID, because through COVID we had, and that was over a period of 2 years plus, we had the weak months turned into strong months and the strong months turned into weak months. And that, of course, turns the seasonal adjustment model upside down. And it will take some time to get back to normality so the seasonal adjustment models can reflect back what is really happening, not what was the upsets during the pandemic. So I think a lot of the ups and downs in the data sets have been perhaps a result of changes to the seasonal adjustment model. And we'll look at that when we look at the data shortly, Graeme. But, at the end of the day, the Reserve Bank can't be saying, hey, we're going to rely on the data as it comes through and then don't ignore it. It's like the data's come through, doesn't sort of work to our feel, so we'll just ignore it,
Yeah.
And it's a little bit like that, Graeme. They've just said, okay, the data was very strong over May, which is our latest data sets, but we're still going to pause interest rates, going forward. It's almost as though that decision was made regardless of the data coming through, which is a
I
complete
think
contradiction to what the Reserve Bank's been telling us.
I think you're right, Doc. I think the decision was made last month, but they were swinging on the fence, so they thought, "Oh, we'll pause next
Yeah,
month. We're so close this month. Let's just
yeah,
agree to pause next month,
yeah. And it's
regardless of
like,
the data."
regardless of the data, Graham, spot on. And,
Mm.
is that the way to conduct monetary policy at the highest level? Isn't it? I mean, if you rely on the data, and we rely on the data here, Graham, for all, well, you certainly do. I rely on the data for my commentary, and you rely on it for your insights as well to your clients. Because if
Mm.
you don't, you're just, looking at a crystal ball, aren't you? And
Mm.
at least if you're following the data and you make sure your data's right, and of course that's reflecting on what I said about the ABS seasonal adjustment models, making sure your data's right, making sure you have a number of different data sets to compare, different data types to compare, then at least you can blame the data, Graham, can you not? If things don't work out as you
Well,
predicted on the data.
you'd rather blame the data because at least it's based on math rather than opinion or perception. Anyway, yeah,
It's like,
I'm really really pleased for homeowners and really
oh,
pleased for
brilliant,
tenants that
brilliant,
we've had a
brilliant.
pause. I'm not pleased for homeowners and tenants because I believe a bit of short term gain, but short term pain for long term gain and a bit of delayed gratification. We've still got, call it 10 and a half, 11 million residential dwellings in Australia. We've
Yep,
only got I think it's about $8 trillion or something, Doc. It's literally three times the ASX, right? In residential property. And we still only have less than $2 trillion of debt, which is about 20-25%, depending on values. So most of Australians' wealth is in residential property. And
yeah,
a lot of them don't have big debt or any debt. 80
yeah,
odd percent of our 80% of our residential market has no debt.
yeah.
So if we've got to control inflation and we've got to control spending, let's just get it done. Yes, it's going to hurt,
Yes.
but let's get it done.
Yeah, look. In a sense, it's a leap into the unknown, Graham, because
True.
I've railed against hitting the economy on the head with a sledgehammer. We don't
Mm.
want high levels of unemployment. We don't want to
No.
ruin lives, but we've got to find the right balance between controlling inflation and still having a robust economy. Now,
Mm.
we're nowhere near controlling inflation at the moment, mate, but we have
No.
one of the strongest economies in our history still.
Mm.
So there's been no pain. There's been no inkling of pain. In fact, it's still party time, and we're
Mm.
still even though yes, it's difficult to make ends meet when interest rates are rising and prices are rising, but you've got a job and wages are rising at the fastest rate in over 10 years. So at least there is that offset to control this unique inflation event. As a result of COVID. So
Mm.
I think that the signs are that we're going to have to accept that our policymakers, and who knows who our policymakers will be in a year's time, and they might be
Mm.
left to clean up the mess. But our policymakers are prepared to live longer or with higher inflation for longer. Which only devalues the value of your currency. The value, your spending power is reduced, And that can't be offset forever with wage rises because employers need to have productivity gains. That is, they just can't be throwing money at you because they want to keep you and not be making the money to cover those wages in terms of their profits. They need to have an improvement to their profits through productivity. That's not occurring at the moment. And you can't sustain that going forward. So, look, I just want to make a note, Graeme. The UK raised their interest rates last month by 0.5%. They are a basket case for inflation. Their inflation, is just looking like it's, getting to that point where maybe it's getting out of control. But they bit the bullet and they had to increase their interest rates by 0.5%, and yet here we have the US election coming up soon, well, next year, and we have Australia moving into pause mode. And even the US has said, we're going to pause, but hey, we're going to raise next month and probably the month after that. It's like, well, why?
Then raise now. Yeah.
Yeah, that's right. I mean, what are you doing, guys and girls? It's just illogical.
Is it economic policy or is it borderline political policy?
Well, the politics really reflects, the issues of personal relationships to some degree, doesn't it? I'm not saying it necessarily is political parties, formal political parties, but it might be just the politics of, those that are making these decisions.
Yeah, keeping your job on the board
keeping everybody happy. Let's keep everybody happy. How can we keep people happy? We'll have a pause. As I said, I have no argument with the decision as long as there is a logical train that points to the reasoning behind the decision. We had unemployment rising. We had unemployment rates rising. We had retail sales falling and inflation falling earlier in the year. And to me, that was like, okay, well, that's a pretty good foundation for thinking about an interest rate pause, that we're finally starting to see some traction. Now, the whole thing then got turned on its head when we saw unemployment rates falling. We saw, I think I said falling, but I meant rising, of course, falling, retail sales rising, and inflation still miles above the target range. So, that goes in the other direction, saying, well, look, we still got work to do here to try to quell inflation. But as I said, as long as you have the justification for it, but just the statement that the governor released for the decision this week was, it was like it was cut and paste from the previous month, decision. In fact, some of it was weird in terms of it said one thing, but the data, which was in direct conflict to the data, and yet the Reserve Bank governor mentioned, and now they're adamant, and they're promoting that house prices are rising everywhere in Australia. And one would have thought that, if interest rates would have been having their impact, it would be on the housing market, But obviously that's way not the case. So there's all these conflicts. And as I said, it's almost, and I think you're spot on, Graeme, that's almost as though they had a little bit of a chat in June, perhaps said, look, it's a line ball. Why don't we go up this month and then we'll have a pause next month? For all you that want to pause this month, I'll tell you what, we won't pause. We'll go up, right? But we'll give you the gig next month. We'll have a pause and that'll keep you all happy. The question is, what if the data doesn't support it? What if it doesn't support it, sort of thing. But
it's interpretive, right, Doc?
Not really, mate. There's nothing. We'll look at the data.
Let's have a look at the data. Otherwise, you and I will be gabbing on all day. Let's see how interpretive the data is.
No interpretive.
Someone says to me the other day, Doc, the data could be interpreted different ways. I said, not unless you're trying to manipulate it to state a certain case or angle. The data is the bloody data. So let's have a look at the data, Doc.
Let's have a look at the data from my housing market, but we'll have some really interesting stuff at the end today, Graeme, so everybody stay tuned. July rates on hold. Interest rates, July rates on hold. Good news. Let's not be a green meanie here. It's good news all around that well, for mortgage holders and the economy in a sense. Directly for consumers, it's good news that interest rates are on hold. Of course, interest rates started to increase. The increase started in May last year, Graeme. We had the usual pause for January. Reserve Bank doesn't meet. Then we had that unusual pause in April, and now we've had a pause in July. But every other month, except July, the holiday, January and April, we've had an interest rate increase. We're now up to 4.15%. We're still below where we were in 2012 by nearly 1%. So historically, this is still a very low rate, but we're on hold. And it will be interesting to see what August brings us. Maybe they're going to take it in turns, Graeme. Up, pause, Anyway, so the July rates are on hold. Reserve Bank has decided to leave those rates on hold over July. As I mentioned, since May last year, it's only the second decision pause in that period. But in my opinion, there's clearly no economic justification for a pause in the latest data. Let's just quickly again reiterate the plan. The plan is, A, we have the highest inflation since the 70s. Inflation is a very, very bad thing that can get out of control and ruin economies for the longer term. So we have to control inflation. How do we control inflation? We stop people spending. How do we stop people spending? Well, we put up interest rates, which reduces their capacity to spend, and it reduces businesses' capacity to invest, and that creates a weaker economy, and that's how we control inflation. So that's the plan, Graeme, right? Our inflation rate, and we'll look at that, the numbers that came out last week for inflation is still, underlying inflation is still above 6%, Graeme. And underlying inflation takes out the volatile elements. We'll look at that shortly. But the target is 2 to 3%. So we're at 6.5%. The target's 2 to 3%. That's a long, 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 long way to go, mate, to get it back to 2 to 3%. So all the roadblocks are there. All the factors are there for the Reserve Bank. High inflation, higher interest rates, the target's 2 to 3%. We're at 6.5%. That's where we've got to head for. And the danger is that inflation is reinforced. So the Reserve Bank had decided to leave rates on pause. We have said, as I mentioned before, that there has been some close calls, according to the minutes from the Reserve Bank, in regard to either pausing or raising rates. They decided to raise rates over June. Looks like maybe they've decided, well, it's the pause advocates' turn to feel happy over July. But the data clearly doesn't support, the economic data clearly doesn't support the rationale for the wait and see, things may be happening, type of look on the economy, which has justified this pause. So unemployment over May, Graeme, which is our latest data, that fell down to 3.6%. The all-time record is 3.5%. It actually fell. We had massive jobs growth over May. We created over 70,000 jobs. That's a big number, mate, in May. The unemployment rate also fell by around 20,000. So the number of unemployed fell by 20,000. That was a really, really big month for our economy. Strengthening economy, record levels of employment, of record low unemployment, record level low unemployment. We have to go back to the early 70s to see these types of numbers in our labour market. And of course, our economy and our society was a different place back in the early 70s. So remarkable data is continuing. It strengthened over May, Graeme, after a weaker April. Again, I'm going to mention the volatility of the ABS. Bad April, which is a holiday month. Better in May. It's up, it's down, and it's following those seasonal patterns, which I think are questionable given what's happened through COVID. So So that's the first major factor in understanding what interest rates are doing to our economy. Although, let's be clear, it does have a lagging effect. It can take some time for this to come through. But Graeme, we've been raising rates for over a year now. Surely we're going to be seeing something, yes, from a very low base, but surely after a year we'll be seeing some impacts to the point where the Reserve Bank would be saying, okay, let's pause because we can see some early signs that higher rates are impacting the economy, but no sign in terms of the labour market, Graeme. Now, the other factor that the Reserve Bank's been discussing is retail sales. Retail sales have been flat until recently, of course, from a very high base, but retail sales increased over May, Graeme. So retail sales also bounced back strongly. In fact, it was the strongest rise since January, monthly rise in retail sales. And the Reserve Bank is constantly telling us about how consumer spending is falling. Well, not over the last month, guys, and that was a strange comment that was made on the day of the decision for the July pause, was that the Reserve Bank was saying, there were signs that consumer spending was falling, and they were like, well, that justifies the pause. Well, it's not in the official data, RBA, because retail sales increased and are well over 4% higher than where they were at the same time last year. And as I mentioned before, inflation is still double the target rate. So the latest data, which is the data that is publicly revealed, other than this sort of, sense sometimes the Reserve Bank gives us that they've got their own little special secret data set somewhere. So, hey,
secret RBA papers, the media call it. They must have some secret data that's completely wrong that's got us to this point.
I don't know. But it's like, trust us, we're the RBA. Don't you worry about it. We're the RBA. We've got our own data. So don't worry about that ABS stuff, that shows a strengthening economy. You can trust us. We think we're on top of this with our own sort of data set. And, they have mentioned constantly about their relationship with various business channels. And with all due respect to the Reserve Bank, their comments regarding the information they're getting from these so-called business channels have all been wrong, particularly about wages growth, which they were telling us for years, our business channel's showing that the wages growth is picking up. Didn't happen, right? And even then they admitted that, there's been some, uncertainty about these business channel, whatever. It's just, it's just a bit loopy, Graeme, to be quite honest. But as I said, all we can do is follow the data trail, follow the commentary that the Reserve Bank has said that we will follow the data as it comes through to make decisions. But there is no economic justification with the revealed data for a pause in interest rates over July. But clearly great news for mortgage holders and the housing market. So I'm not, I'm looking at it from the point of view of the economy and the longer term issues with controlling inflation, but no substantiation, in my opinion, and no substantiation on any data. Show it to me, real data. I'm not talking about consumer surveys and business surveys, which have been showing negativity forever, because people, I think, are telling those that run these surveys what they think they want to hear. It's like they only want to hear bad news. We'll give them bad news, and yet we're out there buying $1 million houses willy-nilly at the moment. But anyway, as I said, I think that's interesting. And will it be the turn of the rate rises next month? Up, down, up, down, up, down. It's making me dizzy. So we had some other data out, Graeme. We'll move on from interest rates, which is a little bit confounding at the moment. But like I said, let's celebrate in the short term, because this is relief for those that have been struggling to pay their mortgages in a high inflation environment. So home building approvals were up. Again, we're just going to mention perhaps there's some seasonal adjustment issues here as well. But because with home building, we look at units and houses, there can be some volatility, particularly with the unit market, Graeme. So home building approvals were up by 20.6%, Graeme, over May. Wow, that's a real That's a big result, up 20.6% over May. And units were up 59.4% over the month. Wow. Houses were flat, up just 0.9%. But when we look a little closer at the data, we can see the reason we had that big increase was big developments coming through in New South Wales over the month. So you can have very large developments approved, unit developments. We saw that in New South Wales, and that's what accounts for the rise. Annual growth levels, however, still remain depressed. I mean, we've seen monthly apartment approvals, Graeme, falling below 4,000 a month. And we have to go back 10 years or more to see those very low levels of apartment development, very low levels historically. Well, not historically, but certainly the lowest we've seen in over a decade. So the bounce back is coming from a very, very low base. And again, you just have to look at those seasonal adjustment modelling at the moment as it's adjusting from the COVID lockdown period. And there's the trend. You can see there the building approval trend just turning up a little bit with those big developments that happened in New South Wales. And hey, look, that's great to see, development occurring in New South Wales, likely Sydney, because they're certainly screaming for more housing in Sydney. So good news there that's coming through. But next week we're going to have a look at building.
I was going to say, Doc, as long as those approvals turn into starts, not just approvals.
Exactly, Graeme, was I was going to say next week we're going to look at how house building costs are going. And that, of course, reflects exactly what you said. And that is, approval's great, but it's got to be a job. It's got to get out of the ground. And that means it's got to be profitable. So there's still some hard yards ahead for developers post the approval process because of very high building costs. So I'm interested to see if we're getting any more relief, and we'll have our latest index out next week to see that. So building approvals still down. We can see that jump up over the month there, particularly for units in the black. But when we look over the year to date compared to the same period last year, and look at the full year to date compared to the full year to May last year, you can see we're still very depressed in terms of our approvals for both houses and units. Home loans also up, Graeme. Home loans bounced back over May, big rise, 5%. Again, I really do believe this is that seasonal adjustment factor where we're seeing it. We're seeing too much of the negatives over a particular month because of the seasonal adjustment factor, and maybe too much of the positives in the following month, again, because of those seasonal adjustment issues. Total loans up 5%, big rise. And shouldn't be surprised because we know the housing market's up and running, and that means people will be borrowing, Graeme. Owner-occupiers up 4.2%. Investors led the charge up 6.2%. First home buyers up 5.5%. So, a reasonable even spread there between investors, first home buyers and owner-occupiers. But once again, home lending is still down significantly compared to 26.7% over the first 5 months of this year compared to the same period last year. And, of course, we've got to understand that that's got a little bit to do with lower prices as well, because this is measuring the value of home loans. And, of course, we know prices have been lower over the past year, so people are actually borrowing less because prices are lower than where they were a year ago. But nonetheless, a good pickup regardless of those issues to do with value. But the seasonal adjustment, again, we're just going to pour a little bit of cold water on that, but nonetheless a predictable increase. And I think we actually discussed it. We see a bounce back following April's fall, and we've seen it. And probably April underestimated the market, and maybe May has overestimated the market. And you can see the trend there for home loans clearly turning up, Graeme. And as usual, it's following the price cycle to some degree. You can see how that follows the price cycle. So a good forward indicator. Retail sales, we always mentioned that, up by 0.7% over the month of May, up 4.2% over the year. The strongest rise since January. The ABS, again, I'm not sure about this, blamed unusual May sales events for the result. Really?
Unusual May sales? Is that
know.
merchandise May, or is it?
I don't know. Could be a
what sales events?
I don't know. Purple Friday, something like that. Not sure what's going on here.
But I don't think there is. I don't think there are any unusual sales events in May.
Well, anyway, the ABS has blamed that as for pushing it up. But again, I do think, and I'm really riding this hobby horse, the seasonal adjustment model called into question. And, Reserve Bank, as I mentioned, has been all about, signs that consumer spending is falling, and that's what they're hanging their hat on in terms of, saying that interest rates are having perhaps some effect. But that's not reflected in the data. Like I said, strongest rise since January, Graeme, over the month, and we're still 4.2% higher compared to May last year. So there's no relief there in terms of those looking to say that interest rates have worked or are working or might be starting to work based on retail spending, which is still a little bit lower than where it was at the end of the last year. Is still well ahead of where it was 12 months ago when we started to rise. And you can see there the trend there just starting to pick up after that weaker start to the year. But it was a very strong finish to last year, particularly over November with those Black Friday sales. Inflation, we also mentioned that. And again, Graeme, this is, we had headline inflation fell from 6.8 to, this is the monthly data set, right? Headline inflation fell from 6.8 to 5.6%. That's a hell of a fall, mate, in 1 month. But the previous month, we saw inflation rise from 6.3 to 6.8. So it's all over the shop here. The previous month, we had a big rise. This month, we've had a big fall. Again, it's just questioning not just the seasonal adjustment scenarios, but also this new measure, and it is a new measure of monthly inflation. It's very volatile, when you're having a surge 1 month and a collapse the next month. But when we take out the volatile items such as fuel and food, underlying inflation was down from 6.5 to 6.4%. That's what I mentioned before. But, it's still 2 to 3% is the target, Graeme, for underlying inflation. That's the Reserve Bank's target. We're currently at 6.4%. So we're light years away from it, right? And we look at the most significant contributors to that May inflation were housing. And we know rents are very strong at the moment and contributing to inflation. And also, of course, building costs are still contributing to inflation. We'll look at that data, as I mentioned, home building costs next week. And furniture. But the big, issue has been fuel fell 8%. Fuel increased over April, which obviously contributed to that big rise over April because of changes to the government positioning and policies on fuel. And that came off this month, so that gave the relief with fuel falling 8%. And that's contributed to the big fall in inflation. But here's the point, Graeme. Inflation has fallen to these levels everywhere in the world, basically, the headline inflation, because fuel costs have fallen. The price of oil, it was $130 nearly a barrel last year at its peak, and now it's, under 70 cents, under $70 a barrel. So that's the big change in inflation. It's the fact that oil's flowing again, that, where supply and demand have matched. It's got nothing to do with interest rates, Graeme. We would have seen this fall regardless because it's a change in the supply-demand balance post-COVID in oil. And as I said, the halving of the oil price has been the main contributor to relief for inflation. Nothing to do with interest rates, mate. And the problem is that interest rates are driving wages, which is now driving, higher prices for services, not just goods that were in short supply, post-COVID. So, monetary policy. But as I said, we've still got hard yards to go. But the adjustment really in inflation to date hasn't been about monetary policy. It's been about the matching of supply and demand in the oil market. So that's our big economic show today, Graeme. Really exciting stuff, I know. It's I think there's some good points there, and I think we need to background everything here particularly if you're looking to make a decision in property. This is the foundation, of course, is how the economy is going to perform. And our strong economy has been a clear driver of the revival in our housing markets, which, Graeme, it's interesting, of course, and we said this last week, that we're now well and truly into winter. It is Happy New Year, Happy New Financial Year, Happy July, which as I look out the window here, it's raining and it's grey and it's cold, but that's Melbourne in July. And of course, it's a little bit that way with our auction markets, as we've discussed. We are going to experience over this month. School holidays now everywhere, Graeme. Every state now is in school holidays, and the auction market is obviously impacted across the board with those usual significant mid-year distractions to buyers and sellers. Everybody's off, mate. They're heading for the sun. They're heading for the Northern Hemisphere, whatever, or else they're just cuddling around the fireside. But regardless, we're certainly seeing what we usually see, and that is a subdued and distracted weekend auction market after what has been a very, very strong autumn selling season, Graeme. In fact, the strongest autumn selling season really we've had since 2017 in a lot of capitals, So let's put it in context. So Sydney, just 363 auctions, Graeme. Most of those auctions in the lower price bracket. Clearance rate over 60%. Obviously, we're well down on our 80% results we had during June, but that's the winter break for you, mate.
Yep.
With very low numbers, and as I said, mostly lower price properties are moving into the market. Some good opportunities there, particularly for those perhaps first home buyers or investors looking to secure a property at that end of the market. Melbourne is standing up quite nicely, Graeme. Melbourne, just a handful of auctions for Melbourne, 347 auctions, which is very low for Melbourne on a non-holiday, long weekend style holiday, but still a 69% clearance rate, Graeme. So the Melbourne market, despite winter, is still hovering around 7 out of 10 sales, chances of a sale on the weekend. So good result there. Melbourne market standing up again. Very few higher priced properties for sale in Melbourne, mainly outer suburban properties and units, but 69%. Brisbane, again, falling away as it's well and truly in school holiday mode, just a 52.6%. Not a lot of auctions reported there in Brisbane. Adelaide, under 80%, a little bit unusual for Adelaide, which has a very strong auction clearance rate history. But again, numbers low in Adelaide, a clearance rate just under 80%. And Canberra, very few auctions in Canberra. And of course, no surprise, a lower clearance rate. Now, we can put that all in context, Graeme. You can see how the winter month is just subduing the Sydney pattern there. Of course, that's just one weekend's results for July. But you can see how that market is clearly built over the year into those very strong results in Sydney, just under 80% through May and June on average. Melbourne also easing over the last couple of months, but again, results very much in favour of sellers. Brisbane, again, the winter market impacting results. Adelaide, still strong but lower. And Canberra, similar to where it was a year ago, but a little bit lower. So next week, we're going to have the June rent report. Are you excited, Graeme? Will we see any relief for rents?
I don't think we're going to see any relief, sadly, but I'm excited to get the data so we can sort of put it out to the community and say, hey, this is what's going on. These are where the opportunities are, and give them some context. So,
yeah, and just some early signs that is coming through because we track the data on a daily basis. That those very, very high unit rents in Sydney are just starting to impact the capacity of tenants to actually pay these rents. So I think we're getting a little bit of an affordability barrier rising. No surprise, because let's remember the latest rents for Sydney units are $750 a week median, which is a big number, Graeme. It's $250 a week more than they were paying a year ago. So that's a lot of money to find in a higher inflation environment. So we'll look at the latest rent report for June. House building costs we'll also look at for May. the latest index data. That'd be interesting to see whether they're continuing to ease. We're also going to see a little bit different next week, Graeme, after a lot of economic data, I guess, today. We're going to look a bit more at what's happening in the housing market in terms of data. So we're going to have a look at the capital city regions, their June home prices. So we're going to look at the major regions in the capital. So this is the capital city regions, Graeme. We do look every month at the regional regions, if you know what I mean, outside the capitals. But next week, we're going to look at how the regions have performed in the capital cities. So particularly, well, we'll look at all the regions, but particularly the major ones to see how they've performed. And, of course, we'll have the latest weekend auction results. So just before we go, Graeme, we have a little bit of an announcement here to make, which is very exciting. Of course, My Housing Market is a robust provider of housing market data. And we have, of course, for Graeme's, in conjunction with Infinity, we have a little app that we've put together, which is just a little guide, a little assistance, a little aid to those that are wanting to understand what's actually happening on a suburb-by-suburb basis in housing markets. And that's based on the current asking prices and rents. And we cover every suburb in the country that has data. The ones that don't have data, we don't bother looking at, of course. But there it is in all its glory. And
well, the only problem, Doc, is they for anyone who's not a client tuning in, there's a password. It's password protected. So if you're at one of our masterclasses, we'll give you the password that Doc changes frequently. And if you're an existing client, we can give you the password. For those of you who love listening in and tuning in to Doc and I, unfortunately, sadly, this is a service we provide to our clientele and community. So if you are Infinity fam or you are attending a masterclass, we'll hook you up with the password. But if not, sorry, not sorry. You need to hang around Doc and I a little bit more. But anyway, Doc, thank you as always. A very insightful week focused on a lot of economical data. Next week, we jump back into the property market. And we're really going to have some strong data over the end of financial year as well, which you pretty much wrapped up anyway, but before end of financial year. And let's see what the data tells us next week, Doc.
Yeah, it'd be interesting to see which regions have been supporting strong prices growth in Sydney and Melbourne, and which regions are breaking out of Brisbane, because we've noted that Brisbane housing market is looking like it's starting to revive, whereas Sydney is well and truly on the march now. In fact, as we saw last week with the June quarter house price data, Sydney house prices are now nearly 7% higher than where they were at the beginning of the year. So halfway mark of the year, 7% higher, Graeme. So well and truly on their way maybe to a 10% growth rate. And I think it's interesting. We get some comments with the latest auction results saying, the market's crashed. You know what I mean? It's happened. We predicted this. Say, well,
it's just winter.
Don't go too early. It's just winter. But
it's just winter.
Again, it's just winter. But we'll see it. We'll reveal it here first. You'll see it first here on the show. So
absolutely,
all good. So I'm sure you're not suffering the chill as much as I am, Graeme, at the moment.
No, it's not too bad. It's not too bad.
Not too bad, but
not too bad.
The good thing about winter is that it's guess what, mate? It's followed by spring, and
absolutely,
and that not just for the little bit of extra warmth that we can get, but also about the usual rebound in the housing market. But that's a long way off, and we've got plenty of water to go under the bridge still. Then, so good to chat today, Graeme.
Yeah,
another big show.
Everyone, we'll see you next. Well, I'll see you this weekend at the masterclass, and everyone else, we see Doc and I next week.
We will.
Thanks,
Good on you, mate. Yes, see ya.